Okay, now, in the first part of the class, we explained the elements and we took these elements from that definition. Understanding exit price, understanding orderly transaction, market participants, people that are knowledgeable, independent, willing, financial ability, and all of that. And the value that we use as fair value is the value at the reporting date. Now, all these must be present before we can call the amount you receive as what? As fair value. With this understanding, the standard mentioned that in determining fair value, there are certain assumptions because some people will argue that no, it doesn't have to be this in all cases. So we need to establish it properly that in fair value determination, these are the assumptions, these are the thinking, these are the things we expect to happen in that transaction before we can say the value we received is what? Is fair value. That's the assumption there. So it's important we lay it out. So the first assumption is that let me say the transaction I know I've mentioned this before, but it is an assumption that the fair value, when we are determining fair value, we assume that the transaction must be what? Must be orderly. That when we say orderly, you already understand that the participants are independent and they are acting in their own interests. Okay? Of course, they are knowledgeable, but they assume that the participants there are independent and they are only there for them to make the maximum benefit from that transaction. It's an assumption that must exist that we believe occur in determination of fair value. Another one is that the asset and liability, okay, the assets and liability are priced at their highest and best value. Are priced at their what? At their highest they are priced at their highest and best value. Please, you need to understand this very well because it's actually direct. Now, this second assumption that the asset and liability are priced at their highest and best value is an assumption that is only related to non-financial assets. They are only related to when I say non-financial asset, I mean assets like PPE or maybe intangible assets, but majorly PPE or probably investment property as the case may be. So, you see, their fair value is their highest and best value in the sense that if you have a land that you are using for, let's say, warehouse, you just put a structure there and you are using it for warehouse. And you know that in that area, if you use that land for, let's say, a shopping mall, okay, if you use it for a shopping mall, the value of that land will go up. The fair value of that land will not be based on that warehouse use right now. The fair value of that land will be based on if you use it for what? For shopping mall. So there was a diet I can ask you just for 2 marks because they know it's something very straightforward. They said that you have a land and this land you are using it for agricultural purposes. You are using it for what? agricultural purposes. And the company knows that if you were using this land for residential purposes, the value will be higher. Okay? The value will be higher. They now say that, but government hasn't approved the land to be used for residential, but they know that probably in a couple of months, government is going to approve it for that use. They now say, what's the fair value? Very straightforward. So using this second assumption is the whole answer, that the fair value of asset and liability, or asset and liability are priced at their what? Highest and fair. What I mean by highest and best value is the use that will create the highest value for them. Okay? And from the question, they were already clear that the use that will create highest value for that land is residential. But I mean, when you are considering that, that use has to be a use that is legal. It has to be a use that is what? Legally permissible. It has to be a use that is physically possible for the asset to undo. And it must be a use that is financially what? Feasible. A use that will be profitable. So again, under this one, highest, the asset and liability are priced at the highest and best value. To get the highest and best value, you'll be looking at uses that are legally permissible, the one that is physically possible for the asset, and the one that is what? Financially feasible for the assets. If that question, they ask you that, if that question has said that government will not approve the land for residential, that means it is not what? It's not legally permissible. So that's the whole idea there. The information here is very straightforward. For non-financial assets or for non-monetary assets, we assume that the fair value determination is based on its highest and best value, meaning the use that will give it the highest and best value. And that use must be legally permissible, that use must be physically possible, and financially what? Financially feasible. Now, another assumption that market participants make is that fair value is determined. Fair value is determined in the principal market. Fair value is determined where? In the principal market. However, if there is no principal market, we use the most advantageous markets. Fair value is determined in the principal market. However, if there is no principal market, we use the what? The most advantageous market. Again, I kind of asked this before for like 7 marks or thereabouts. We'll solve that question very soon. So one of the core assumptions here, which I mentioned, I think under the transaction, I mentioned it, that it assumed that the transaction prices are determined from a principal market. And I told you that principal market is the market where there is high volume of activity on that asset. Okay? It's just that you want to get the market for shares. That's the principal market. And the prices in that market is the price that is the fair value. Or probably you sell crude. Which price would you use for crude? Crude oil. Yes, the international price. Everybody knows the Brent crude price. It's quoted almost every day. Right? That market there is the principal market. But you agree with me that it is not all assets that will have that kind of structured market, where it's fragmented here and there. So it is now left to you. If that's the asset you are considering, then we should look at the what? The most advantageous markets. And from the name, the most advantageous markets will be the markets where you will get the highest benefits. The market where you will get the highest profits. Benefits or what? Or profits. That's the most advantageous market. So there was a direct they gave you a scenario question. They now gave you market A, market B, market C. They now gave us the quantity in each market. They gave you the selling price, transaction costs, entry price, and that was it. We are now asked to determine fair value. We will get there. You see, very straightforward question for 4 marks. First, you need to identify the principal market. Since they gave us the volume of transaction in each market, the market that has the highest volume is our principal market. The selling price in that market will represent our what? Our fair value. Yes, they gave us selling price, and they now give us some costs. You see, when you are determining fair value, you do not deduct transaction costs. Because fair value is the price that is received to sell an asset. Transaction costs, like probably you did some marketing on the asset, probably you used an agent or whatever. Those kind of costs, we believe that they are not characteristics in that market. They are not characteristics of that asset. It has nothing to do with that asset. Because you can bypass those transaction costs. So you will see that when we are determining fair value, we don't consider cost to sell. We don't consider transaction costs. However, the standard says that if you have to transport, if it's an asset that you have to transport to a location, he said that one you can deduct that one. He said that one is a characteristics of that asset. If it's an asset that you have to what? Transport. Or probably before you can sell in that market, you will pay money to sell you will pay an entry price. He said that one you can deduct it. Okay? Those two commonly we do deduct when we are determining fair value. So this third assumption, key things that you need to note. Number one is how to identify the principal market, which is the market that has the highest volume. And when you identify the principal market, the selling price in that market is our fair value. And never deduct transaction cost. Never deduct what? Transaction cost. However, if you have to transport the assets, if you have to pay to enter the market, those are characteristics of the asset. You need to deduct that in determining your what? Your fair value. Your fair value. Nike, you want to ask a question? Okay. So these are the assumptions. And other assumptions are really related to this. Like we assume, this one is an assumption that the price at the measurement date is the fair value. It is an assumption also, because another people can argue that no, it is an assumption that the market participant make that the price at the measurement date is the fair. I just hammered on this because these are the areas where we could see questions in the exam. any questions?